Today we're going to look at 5 best high yield investments that you can make in 2026. I did an analysis for over 40 investment vehicles in Kenya, those that have done well in 2025, and only 5 or 6 will actually make you wealthy or rich in 2026. Now, here is the crazy part. The wealthy and the poor in Kenya invest in completely different vehicles or things. While the first category focuses on hype, the other category focuses on performance. And if you don't understand the difference between high yield and high risk, you're going to lose money this coming year. That is guaranteed. But in this video, we fix that. But there is a problem. Most Kenyans are not broke because they are lazy. People are broke because their money is silently dying. I will explain. Inflation sits between 6% and 8% every single year. Meanwhile, your bank pays you from 3% to 7% before fees, before deductions. What does this imply? That if you saved 100,000 Kenyan shillings last year, you did not grow your money. Your money lost its purchasing power. By this I mean what the money could buy a couple of years ago is very different from what it could buy last year. Your money could buy less fuel, less groceries, less electricity, and basically less everything. And the trap is simple. Not doing anything is the most expensive financial decision you'll ever make. The more your money sits idle in a savings account or in a bank, the more it loses value because inflation eats away the value of your money. Here's the part that nobody talks about. In 2024 and 2025 shifted the Kenyans' financial landscape. How? I will explain. The interest rates went slightly up. Government started issuing higher yield bonds. The corporate commercial papers hit double digits for the very first time. Money market funds became more competitive and more available. Saccos increased their dividend yields. Stocks on the Nairobi Securities Exchange are slowly recovering from historic lows. So, for the very first time in years, ordinary Kenyans can access returns that were previously only reserved for institutions and wealthy individuals or wealthy insiders. But most people don't know where to start, or worse off, they jump into scams that will constantly promise you 20% per month. That's a lie. So, before we dive in, I want us to speak the same language. Let's look at the key terms that you need to understand before we get into the real stuff. Term number 1, liquidity. Liquidity is how fast can you get your money back if you want it. Money market funds will give you higher liquidity. Saccos deposits, bonds rates, the very low liquidity. Term number 2, volatility. How much the price moves up or down. Government bonds are very stable, while stocks, on the other hand, are like an emotional roller coaster. Term number 3, yield. This is the return that you earn from your investment. This can be in form of interest, dividends, or capital gains. Term number 4, minimum capital. How much money do you need to begin? Some require 500 shillings, as low as 500. Some require 50,000 plus. So, risk level, the last term, probability of losing money. Every investment has got a risk. If someone tells you that the investment that they are advising you to go into doesn't have risks, then they're lying to you. So we will rate each of those that we'll share on a scale of 1 to 10. Now that we are good with the terms, we shall be speaking the same language. Let's look at important considerations before you start investing. These are the rules that the wealthy use before putting money into any investment. They look at number one, risk versus return. If the risks are higher, this equates to higher volatility. If someone promises you higher returns and no risk, that is a scam. That's a red flag. Liquidity. Some investments will lock your money for months or even years. If you need quick access, then money market funds will be your best friend or your best option. Diversification. Some people will put their money in one asset, all their money in one asset. Wealthy people spread their investments across different vehicles. They'll have some money in a money market fund, some money in bonds, some money in Saccos, and some more money in equities. Diversification is not fear. Diversification is risk engineering, your ability to manage risks whenever they pop up. Important thing to consider is the due diligence. Never invest money somewhere because someone recommended it. You have to check. And what do you check? You check the fund manager track record. You check audited financials. You check default history. You have a look at the reputation and then have a look at the regulation status. If you don't understand it, don't buy it. Then the last thing is regulation. Only trust investments that are regulated by Capital Markets Authority, Central Bank of Kenya, SASRA, the one that manages Saccos, and RBA. Regulations do not eliminate risks, but it protects you from fraud. Now that we are fully covered, we are fully prepared, we know the terminologies and we know the considerations, let's look at the top 5 best high yield investments for 2026. I'll start with number 5. Dividend stock. Now, when we talk about dividend stocks, it's important for you to understand one thing, that they have got high yield potential but high volatility for long-term thinkers. Now, what are they? Dividend stocks, when you buy a stock, you are buying ownership in a company that is listed on the Nairobi Securities Exchange. You get paid dividends and the share price can over time grow to a bigger value compared to what you bought, the purchasing price. What are the actual returns? Some top companies have delivered 8%, 9%, some up to 11+% consistently for a long period of time. This is one of the things that you have to consider when you are deciding on what to invest in. Examples are banks, telecoms, and selected manufacturing and utility companies. The minimum capital that you can invest in is as little as 100, but realistically, aim from between 5,000 to 10,000 plus per position. Time horizon, 3 to 5 years minimum if you want meaningful returns. Now, here's the catch. The stock prices can swing wildly. Today it can be down 10% and tomorrow it can be up 15%. What does it imply? That it requires emotional discipline. The risk level, 7/10. Why? Because of high volatility but strong long-term reward for patient investors, those who are very patient. Now, who is this for? Dividend stocks are for people who can handle price swings, medium to high risk tolerance, long-term investors, and anyone who is seeking dividends plus capital appreciation over time. Action steps: open an account on either of the following: HISA app, Bamboo, NCBA investment platform, or your stock broker. This can be, there are several of them. You can just have a look at them. Start with a stable dividends paying company. Investment number 4, the second one, but I started from the bottom: corporate bonds and commercial paper. This will give you high yield than government bonds, but with more risk. What are they? Let us break them down. You are lending money to bigger companies. You are lending money to corporations. Think of Safaricom, banks, manufacturers, utilities. They pay you a fixed interest, but for a certain set period. What are the actual returns? Oh, the numbers look like 13% to 18%, depending on the company and the terms. Minimum capital: most corporate bonds will require between 5,000, 50,000 to 100,000. Some commercial papers require over 100,000 Kenyan shillings. What is the time horizon? Aim for between 6 months to 5 years, depending on the particular instrument. What is the catch? If the companies struggle financially, they may delay payments. We also have the risk of corporate default risk. Even bigger companies, they will sometimes fail to pay. What is the risk level? Is 6.5 out of 10. Who is this for? This is for medium to high risk investors, people who want yields above treasury bills, and those who are comfortable locking money for a certain period of time, can be long period of time. What can you do? What are the action steps? Buy through your stock broker, can be a bank or just any other stock broker. Look at the investment banks: FIDA, Dyer and Blair, then NCBA. Watch for Capital Markets Authority approved corporate bond issues and invest in them. Go to number 3, Saccos. When we talk about Saccos, we are talking about high dividends plus loan access but low liquidity. We mentioned liquidity. Now, what are they? When we talk about Saccos, Saccos are regulated cooperatives where members save monthly and earn dividends at the end of the year, annually. What do the returns look like? Averagely between 8% and 15%, depending on the Sacco. There are others that have gone even over 18. What is the minimum capital? It has got monthly contributions of 500 plus. Then the share capital is also required. The time horizon, 1 to 3 years before meaningful dividends, before meaningful returns. Now, what is the catch when we talk about Saccos? Your money is, number 1, your money is not liquid. Number 2, withdrawals can take months. Number 3, quality varies widely. Some Saccos are excellent, others mismanage funds. You've seen it on the news. Risk level, 5.5 over 10, but this varies with the governance of that particular Sacco. Who is this for? Consistent savers, people who want dividend plus cheap loans, medium risk tolerance, and long-term investors. Action steps: choose a SASRA regulated Sacco, for example, Stima, Safaricom, Harambe, Kenya Police, Kenya Medical. Just research and check on governance and audited reports. Investment number 2, government securities, and these are either treasury bills and or bonds. This is one of the safest investments in Kenya at the moment now. What it is: What is it? You are lending money to the government of Kenya. They pay you a fixed, predetermined interest. How do the rates look like? The returns. Treasury bills between 8% and 14%. Bonds between 12% to 14, 15 plus percent. Infrastructure bonds can be not the same between 12 and 14.5 plus, but they are tax-free interest. You don't pay the 15% tax on your returns, on your interest. What is the minimum capital? Treasury bills, 50,000. Treasury bonds can also be 50,000, but some will require 100,000. Time horizon, 3 months to 20 years. The catch, liquidity is medium to low. You can sell on secondary markets, but prices will fluctuate. Interest rates may be taxed unless it is infrastructure bond, which is not taxed. Risk level, 2/10. This is among the lowest risk investment in Kenya at the moment. Now, who is this for? Conservative investors, people seeking stable returns, those that are building predictable income streams. Because remember, when you talk about bills and bonds, they've got a predetermined interest rate. So if you want to build a predictable income stream, then go for treasury bills or treasury bonds. Action step: buy through CBK, though CSD platform. It's a simple online platform that you can use, or use a trusted investment bank or a broker. Investment number 1, money market funds. This is the best combination of yield, safety, and liquidity. If you want the three, looking at yield, safety, and liquidity, then go for money market fund. What are they? These are professionally managed funds that invest in treasury bills, bonds, commercial paper, and fixed deposit, so that you can earn consistent daily interest. How do the returns look like? 8% to 15%, depending on the fund. Top money market funds always outperform inflation every single year. Minimum capital, as low as 100, 500, all the way, the amount that you want. Time horizon, daily compounding, perfect for short-term and medium-term goals. What is the catch? Returns normally fluctuate with market conditions. Not all funds are well managed. Risk level, 3/10. Very low risk. They are very stable. Who are money market funds for? Number 1, beginners, emergency funds, short-term savings, people who are building capital for bigger investments, and anyone who wants a stable return without locking money in a fixed asset, in a fixed vehicle. Action steps: look for top capital markets authority regulated money market funds, and this might include something like NCBA MMF or Mutual MMF, Cyton MMF, Sanlam, and Etika. There are others that you can have a look at. You can deposit money via M-Pesa or directly through the bank. Good. A bonus, the last one, REITs, Real Estate Investment Trusts. This is where you get exposure to real estate without having physical property. The returns vary, but well-managed REITs offer consistent income and property appreciation. They've got low liquidity, they've got medium to high risk, but great for long-term investors seeking diversification. Platforms like NSE, HISA, and stock brokers will give you more direction and instructions on how and where to begin. As we conclude, these are the top 5 best high-yielding investment in Kenya going into 2026. Not the hyped ones, not the scam ones, but the real ones based on data, regulation, performance, and risks. Let me know what you invested in 2025 in the comments below, and what assets or vehicles you are likely to invest in come 2026. If you want more, if you want part 2 of breaking down how to build a full investment portfolio, let me know, and we'll do that. That is it for this video. Thank you for sticking around, and I'll see you in the next one. Bye bye for now.